Hi, everyone. As we're all entering the viewing area, going to give everyone a few seconds to make sure they're up and running. Those of you who don't know me, my name is Bob Ferguson. I'm the CFO of the Chester County Community Foundation. I'm sitting in for Karen today, who had a previous commitment. Welcome to our annual investment forum. I'm going to turn it over briefly to our board chair, Zeb, to give a couple introductory comments, and then we'll get into the heart of the program, which is really hearing from the experts today about the state of the market and their expectations in our performance.
Good
Beth, do we have
afternoon,
anyone
oh,
else
go
in the
ahead. I'm
waiting
sorry.
room still, or is everybody moved in?
Everybody's here,
Excellent. Okay.
and I'll let folks in as they arrive.
Just a couple housekeeping items. We have put everyone on mute so that we don't have any background disturbances while we're going through the presentation. If anyone does have any questions throughout the course of this session, please either drop them in the chat, or you can use the raise your hand function, or if you just want to interrupt us, we'd be happy to go to you. But if you do that, don't forget to unmute yourself so that you can be heard, please. So I'm going to take us one slide forward and have Zeb start us off, and then I'll jump back in a couple seconds and we'll go through the rest of the agenda. Thanks,
Thanks,
Zeb.
Bob. Thanks, Bob. Good afternoon, everyone. As Bob mentioned, my name is Zeb Davenport, and I serve as the chair for the Chester County Community Foundation. We want to be respectful of your time. So, as you can see on the slide, um, I have actually 1 minute left before before I turn it back over. No, no, no. We're going to walk through these pretty quickly. So, Bob, you can go ahead and advance. I just want to give you a little bit of background about the foundation. As many of you know, our mission is to connect people who care with causes that matter so that their philanthropy makes a difference both now and forever. And I also want to give a shout out and thank our board members who give of their time, their treasures, and their talents. These folks are diligent and are serious about the business of the Community Foundation. I mentioned our mission already, and our vision is very simple, right? The Community Foundation, we're a philanthropic catalyst for positive change. We want to be strategic and intentional about engaging donors and partners while we address the common good, transforming our region to make it into a better place for all. We have a couple of key or core values. And I'm not going to read every one of them. You can see them on the screen. But quite frankly, we are passionate about what we do, why we do it, and how we do it. We want to be responsive to our donors and to the needs of our community. We want to be proactive, not wait around, but be forward thinking in what we do so that we can serve the needs of the community. And obviously, we want to be inclusive with everything that we do. And it takes a collaborative effort by everyone involved, not just the members on the board, not just the donors, the folks who have donor advised funds, but even folks in our community so that we can continue to raise money and do what we do best, and that is serve the needs of our community. And frankly, and without, I say last but not least, we want to maintain the highest ethical standards, integrity, stewardship, and transparency while being professional in everything that we do. And finally, I'll chat a quick, if you can flip it to the next one. Our goals, as you can see, they're bi-directional. We, first of all, in the center, we want to make sure that we are a stable institution. And then if you look on the side, you can see we're serving the needs of the nonprofit community. We want to provide resources and strengthen the nonprofit community. If you look to the left, while we continue to grow philanthropy by inspiring others to engage and donors to continue to give to our funds. We have a great group of folks who do our fund advisor and our donor services. And then at the very top, when we think about the community needs and priorities, we want to serve as a leader and an advocate, bringing people together, bringing institutions together, and bringing resources together to understand and positively influence the region and community issues. With that, I'll turn it back over to the trustee driver, Bob. Thank you, Bob.
Thank you, Zeb. I appreciate that. And I also wanted to add my thanks to everyone who's in attendance today, and especially those of you that serve on our investment committee, along with our investment partners, some of which you'll hear from later in this presentation. And I really do think we all benefit from hearing directly from those folks today, and appreciate the time they're taking to address concerns and questions. And I wanted to point out that if anybody has any questions that don't get answered today, please reach out to me directly, and I will reach out to the experts and get back to you shortly with some of those answers. So I'll provide a little bit more detail on the information that Zeb led off with, probably 5 minutes or so of information on this slide and a couple slides to follow. But just to let you know, all of this information is available in a number of formats in addition to what you see on the handout today. It's in our annual report that hopefully you all have a copy of, as well as on our website. So if there is any other follow-up to any of the stuff we talk about today, please don't hesitate to reach out to me or any of our staff members. So if we start in the center of the slide today, the core function of what we're trying to do is legacy philanthropy, allowing our fund advisors to intentionally give during their lifetimes and also set aside a legacy that they can continue to support the organizations that they believe in after they have passed on. So we manage approximately 435 charitable funds. You can see the numbers here, roughly 145 million in assets. And they are broken out by this pie chart you see down at the bottom of the screen here. The largest component of our fund types is our donor advised fund, which is about approximately half of our in total fund pool. We also have field of interest funds, where grant making is focused on a particular geographic area or a particular cause. And in both of those cases, the fund advisors are making the granting decisions either completely on their own or with some assistance from our staff. We have nonprofit endowment funds that have been established either by the organization directly or by third parties to benefit those organizations. And they benefit through the ability to take an annual withdrawal from those funds each year. We have scholarships that primarily benefit high school graduates entering college or trade school, where the award decisions are made either by the guidance departments of the local high schools or by panels established by the fund advisors following the guidance of IRS regulations. And our last category is the CCCF entrusted funds, where the community foundation is actually making the grant decisions ourselves through a couple of different vehicles, one being our grants committee and the other being grant panels, where we have other constituents of ours participate in the grant making process. So if you start in the lower left-hand corner and work our way around the edges of this slide, I'll take 2 minutes to tell you a little bit about what our core programs are. The most basic one is our family and individual philanthropy services category. And we are supporting those families in a variety of ways, including things like organizing family meetings to review potential grantees, arranging site visits to nonprofit organizations, doing research of organizations in a particular field of interest, or simply having conversations with children or other successor advisors so the traditions that are established by the fund advisors are passed on to the next generation when they take on the grant making duties. We have several areas at the top of the page where we program with others in connecting, promoting, and partnering with other organizations and individuals. And a couple of those areas include Chester County's America 250 efforts, where we're focusing primarily on the concepts of liberty and justice for all, as well as some other local heritage and civic engagement causes. We have our community conversations, which we convene primarily on Zoom, but sometimes in person on current topics. We try to connect individuals with others to support each other and the greater community in general. And on the far lower right side here, we have our nonprofit capacity building services area, which include a couple of different categories: planned giving services, our annual Board of Directors Institute, which is a one-day training opportunity for local board members and committee members, various additional board trainings and roundtables, and our nonprofit peer learning sessions. For fiscal 25, recently concluded, we granted out about $6.6 million to the local nonprofit community, primarily in Chester County, but also throughout the U.S. as well. We have another pie chart here. We love our pie charts, and this breaks down the areas of influence for those dollars. You can see that human services makes up about half, but there are also significant dollars going out to each of the other categories that we have listed in the chart here. And this is probably consistent with the past several years in terms of the breakout by field of interest. The next several pages list the funds that are actually, this comes directly from our annual report, and lists all of the funds that we hold in trust by category, by name. You can see the funds that were established in the most recent fiscal year are highlighted, and each of those are listed here over the course of the next couple of pages. I did want to point out, in all of our grants that go out, we send a letter out to the nonprofit organizations identifying the source fund by name so that those folks can get recognized as being the ones that recommended the grants in the first place. Unless folks choose to be anonymous, which they can choose to do so, but other than that, all these folks are, all the funds themselves are named in the grant letters that go out. The next slide here shows a listing of our Ben Franklin Legacy Society members. And this list represents individuals who have included the fund at the Community Foundation in their estate plans, either in their will or as a beneficiary to their IRA or life insurance policy, for example. And we work with these individuals currently to establish the purpose of their funds and the causes they would like to support, so that when we take on the grant making decisions for them, their intentions are carried out going forward. But today's focus is really on the appropriate stewardship of the funds. And with that, I will turn it over to Mark McCarron, who chairs our investment committee, and he'll walk us through the role of the committee, the overall aims of our investment portfolio, some details on the asset allocation targets that are in place now, and the general model that we follow in our investment practices.
Great. Thank you, Bob, and welcome everyone. Thank you all for joining us today. We look forward to this event every year. Every year there's always something interesting to talk about, big picture, so we're very much looking forward to diving deeply into some of those big themes and markets and economies and what it means for you. Before we do that, I want to briefly introduce myself. My name is Mark McCarron. I am a board member of the Community Foundation. I sit on the Grant and Scholarship Committee, and I also chair the Investment Committee. Very proud to be associated with the foundation and all the good work that they're doing. And so, my role and the role of the Investment Committee is really one of oversight, strategy development, and really ensuring that the portfolio and the entrusted assets to the foundation are invested in a way consistent with your objectives and goals, but enable you to do what you'd like to do in the community. And so this slide just runs through the investment committee. There's about 8 of us on the investment committee today. We've thinking about our role is, how do we develop and evaluate the investment policy that should be implemented to ensure long-term return objectives are met within a risk-controlled way? That's the key. If we can do it, we do that through looking at and assigning asset allocation targets. So that's really the mix of stocks, bonds, cash, and other. Each one of those asset classes has its own characteristics and own risk profile. We want to make sure that it's a balanced approach, not more aggressive on one side or not aggressive enough in many ways to outpace inflation. So we can get into that. We also want to make sure that we're monitoring the results of the portfolio from a return and risk perspective. We have a number of ways of doing that to ensure that it's keeping pace with other options, other strategies out there, but also just keeping pace, again, with the objectives set at the beginning. These funds are entrusted for a long period of time, perpetuity even. And so we want to make sure that we're able to meet those return objectives over the long run, but also enable that regular annual contribution to those causes that matter in a consistent way. The role that we have on the investment committee is not only to oversee the primary outsourced chief investment officer, which is Harold Callahan, who's on the phone today and will be presenting shortly. but also a number of medallion partners, which have been approved and selected by donors for very specific asset allocation and portfolio reasons. So our role as the investment committee is just to oversee all of those investment providers to ensure they're doing their best on your behalf. Um, and we report into the board to ensure that the community foundation itself understands what's going on out there in the markets and the economy, how's that translating into the portfolios that are entrusted to us, and making sure that we have regular reporting and feedback. And so the short answer is we're responsible for oversight, strategic development, and implementation portfolio review. And a great way to do that, we meet every quarter to ensure that we're monitoring all of that. So the next slide just goes through what we're monitoring for. We have long-term return expectations associated with this portfolio, and the return that we're looking for is over and above what we refer to here as a minimum financial benchmark. That's the idea of the portfolio return should beat inflation, should meet the needs of a 5-year annual spending rate, and do that after fee. And that's really the objective of the overall portfolio. And we can go into a little bit of that, and Herta will talk a little bit about benchmarks in general, but also how they're implementing the portfolio. And then we'll learn a little bit more about how the medallion partners are thinking about what they're doing. The other thing on this list is just minimizing the downside risk. And that is how we do that on this slide here, which is breaking the portfolio down into growth assets, which are equity and stock market oriented, diversifiers, which are typically fixed income, and then fixed income, which is other. That idea of mixing the portfolio into different asset classes is important. On the right-hand side of this chart, as at the end of the year, about 70% of the portfolio were in growth-oriented assets. That's really where you're going to beat that inflation number. Inflation's been a topic of conversation for many of us in the industry, and we'll learn a little bit more about maybe where it's going with the experts on the team. The fixed income allocation, 25%, is really about the bond allocation, ensuring that there's some complement, risk management, buffer, if you will, to economic uncertainty and volatility, and that's where you typically get a good yield nowadays, but also a nice diversifying component. And then the diversifiers are small allocations to other alternative investments, private assets, hedge funds, that type of thing, that really don't have as much correlation to the rest of the market, and they can also be very helpful. And the chart on the left-hand side just talks a little bit about how the allocations are made today in major asset classes. One thing I'd point out is U.S. equities or U.S. stock market represents 27% of the portfolio, the largest single allocation, but there's a lot of other things in this portfolio generating return on behalf of the portfolio. That's international markets, emerging markets, real estate, private equity, and as I said, the private on the investment grade fixed income. So that's really the big picture. We talked a little bit about our partnership with Herta Callahan, our what's called an outsourced CIO. They're responsible. They have discretion within the guidelines given to them by the committee to implement that portfolio. They manage approximately 70% of the assets entrusted to the foundation. However, there's about 30% managed by what we call the medallion partners. And you have the names of those investment firms here: Truist, Merrill Lynch, Vanguard, S&T, Phoenixville Federal, Creative Planning. We have a number of representatives from each one of those here today. And again, we're looking forward to seeing what their views are on the markets and hopefully answer some of your questions. So with that as an introduction, I'd like to turn it over to Chris Valerio and Nick Fazzi from Herta Callahan, a long-term partner for the foundation, with the foundation, really to introduce themselves and to start us off.
Great. Thanks, Mark. And again, I know there's going to be a lot of thank yous, but for everybody taking time to join us today, it's just, it's great. And Nick's going to go into a lot of the market review last year. There was some interesting, really, really interesting stuff that went on. But I always think it's good to kind of level set just quickly who we are. And I think a lot of you on the call already know who we are. We manage 26 billion. Half of it's for institutions, half of it's for families. There's a lot of overlap and relationships that happen, obviously, across the business. One of the things that I think we're so proud of, we've been working for the foundation for 23 years. And if we look at our average retention down in that right-hand corner of 15 years, it's almost, I guess, 50% more than that number. So absolutely thrilled. And just to put that into context, Bob, you put out a really important number, talking about 6.6 million in grants last year to the community. I think when we started, somebody's probably going to have to channel check this, but I think it was around 200,000, maybe 300,000 was the first grant. So I think it shows the power of our relationship, the power of, quite honestly, just compounding capital, and the community foundation continuing to grow its mission by bringing in additional donors. So that's the thing that I think Nick and I talk about all the time that makes us most proud, is just this long-term relationship that we've had. Maybe Bob, go to the next slide. So Mark spent a good amount of time talking about the role of the committee. And I can't emphasize enough how getting the governance structure right, understanding where accountability lies across the different parties, is really, really critical. We jump in that managing fiduciary role to serve as the chief investment officer. So in essence, the community foundation, if they wanted to build their own in-house staff, it would be multiple millions of dollars to build that staff. They've decided to outsource it to us. Acting as a chief investment officer is the only thing that we do. We don't have any other lines of business, investment banking or mortgages or anything like that. We just manage money. So we can focus on making sure that the investment mission that the committee outlines is mapped according to asset allocation, manager selection, and then day-to-day investment decisions that happen to have that Nick and I talk about and make along the way as market conditions change. And then ultimately, what the Community Foundation is hiring us for, in addition to that, is the hiring and firing of third-party managers. So maybe, Bob, with that, let's go to the next slide. So this will show the schematic about how we think about markets. And I think everybody on this call knows it's very, very difficult to beat markets. Nick's going to pick up on some of the major themes last year with the proverbial Magnificent Seven that it feels like all of us investment folks have been talking about for a long time now. But we will allocate passively. We just will take a portion of the portfolio, typically 40 to 50% of the public equities, and allocate them to index funds that will give us the market return. And then we'll start to layer on, based on different views and valuation and how we're looking at the market, there could be some targeted strategies that we'll look to either replicate or we'll add on an ETF, for example, dividend yield versus momentum. What types of stocks fall into that category? And if we want to shift the factor exposure across the portfolio, we have the ability to implement that. And then when we do hire third-party active managers that are going to pick stocks, we have a label here called high conviction. High conviction basically means to us, most of the managers in that pool are going to own less than 30 stocks. And we want them to take a lot of what's considered benchmark deviation, because we're already getting the benchmark in our indexing exposure. So let's implement a manager that's going to own 10 stocks or 15 stocks and vary his performance or hit her performance around the global opportunity set. And then we'll map that back and build the exposures across the portfolio to make sure we're getting the optimal exposures that we want. And then lastly, the real build out with this portfolio over the last, I would say, 5 years has been on the private market side. And there we're trying to capture just, typically what you see is this whole notion that companies are staying private a lot longer. And we think about it kind of in a bifurcated manner. And maybe two quick examples. I don't know if maybe you've seen the bowl, the Duke's Mayo Bowl, but it's this mayonnaise that was bought by one of our private equity companies under the brand of Sour Brands. They paid $300 million for a group of consumer goods that they then later sold for $1.5 billion. So We're trying to do it through the buyout segment. Then we're also obviously trying to do it through the venture capital investment. And, one of the big successes that we've had there is OpenAI, which everybody knows is the ChatGPT engine. They created a venture portfolio that we were one of 5 investors that initially invested in that. So we're trying to capture across the broad spectrum and do it in a liquid controlled manner, but trying to get what Mark had indicated as really that long-term real return appreciation across the portfolio. Nick, do you want to jump in and maybe put some bookends around what we did in the portfolio and some of the drivers of the market last year?
Yeah, sure. And welcome, everyone. I'm going to go through the market update, also portfolio positioning and performance. And if you're like me and you're saving for your children's retirement, or you're nearing retirement, or you have your own personal portfolio, and you didn't look at the markets at all this year, and you open up your statement in early January, you likely were very pleased with the stock market returns that you saw. And this comes off the backs of a very strong 2023. 2024 was very kind to the stock market, and no different in 2025. I think underlying this, there was a ton of volatility. So if you rewind the clock back to the first quarter, we had the DeepSeek announcement with competing large language models from China that put some downward pressure on tech stocks. And then following that, you had the infamous or famous tariff announcements in the Rose Garden that really put some downward pressure in stock market volatility in play. Since that time, it's sort of been a one-way street forward as the market participants got comfortable with this. Renewed enthusiasm on the artificial intelligence theme continued to push forward. Emerging markets and European equities having very, very strong years on a relative basis. Some of that aided by a weaker dollar, and also the normalization of interest rates was a tailwind for fixed income assets. So the portfolio benefited pretty dramatically in terms of being positioned towards risk assets. I think from our perspective, we continue to be tilted on the margin to areas that we think carry a little bit less valuation risk. And so how we're doing that within your portfolio is we remain overweight European stocks as a way to capture that valuation delta. So we're giving ourselves a little bit of a margin of safety. We're tilted away from the composition of the US-based markets, which are more tech-oriented. That has helped last year. It's also helping this year and serving as a tailwind. And then within the US market, where we're not passively oriented, as Chris mentioned, roughly 50 to 55% of the exposure in the equity market is passively oriented in index stocks. On the margin, we're tilted away from stocks that are carrying some of that valuation risk associated with this singular AI theme. Not that we don't think it's going to be transformative, not that we don't think it's going to lead to some sort of productivity gains. Obviously, stock market returns in the past have been driven by tech. I think at this juncture, we're just a little bit skeptical of the forward earnings growth that's built into some of these valuations, and we have a slight tilt in a more conservative manner. The last thing that we're doing is for the portion that's invested in fixed income. You can flip to the following slide. That's fine. We have about 30% of the portfolio in fixed income assets. So the portions that's designed to be a stabilizer, designed to provide income, it is now playing that role in the portfolio. So within that portion of the portfolio, we're overweight treasury bonds. We prefer the liquidity and safety of the treasury market. And we've also taken on a little bit more interest sensitivity or duration as a means of capturing what we think is an attractive insurance policy should we have an unpriced recession, a hard landing, some sort of market correction. And that's much different than the environment and how we had it positioned if you dial back the clock to 2021, the 2022 timeframe when we had negative real rates and we were much more defensive within that portfolio. The only other thing I'd highlight is that private equity target. We're building to a 10% weight. It takes time. So this is a conversation that we're always having with the investment committee. This most recent investment committee meeting, we had our private equity team present just to give an update on the portfolio and our means to access some of the themes that Chris was talking about in terms of adding maybe a little bit incremental return above and beyond of what we're able to get in the public markets. But by and large, that 70% exposure to equity-oriented assets is what allows us to deliver on the objective that Mark described earlier in the presentation. So we're trying to build a portfolio that's going to allow us to earn, spend, or your grant dollars that are going out the door, and some sort of inflation bogey to keep pace with that metric. Okay, then in terms of performance, you look at where we highlight that minimum financial benchmark, which is what I just described, right? Sort of an 8% return on a 10-year basis. We're right in line with that. So the portfolio composition that we're putting together, I think, is doing a good job of delivering on that most important objective. And then when you look at the results for this year, a 16.5% return, very strong absolute results in this year period. The 3-year results very strong, once again aided by that tailwind within the equity portfolio that we described. So materially outpacing that financial benchmark, but slightly behind just some passively oriented indices. And so serving as a headwind, I think, during this time frame is as Chris alluded to, any deviation away from the market in terms of small cap stocks, value stocks. If you own international stocks prior to this past 12-month period, right? These were all headwinds in terms of being passive benchmarks. I think the results that we've delivered here, we look at a lot of databases, we look at a lot of peer universe comparisons. The year-to-date and the 3-year number, we think are very strong in terms of a universe comparison. So we're happy that we're delivering in terms of beating the financial benchmark, and relative to our peers, we think we're doing a decent job. Okay. The other piece of this is we manage a quasi-endowed portfolio that has a different risk profile, meaning we're taking on less equity orientation within the portfolio. So the main difference between this pool is more of a reliance on investments that are to behave much less volatile than the equity markets. So we have much more investment grade fixed income here. We have a higher cash allocation, and we do not take on the quarterly illiquidity associated with that active equity team that Chris described earlier in the presentation. So it's also done a good job in being liquid in nature, delivering returns that we're not going to anticipate this level of high returns that you see on the 3-year period here. Once again, the primary driver there was from the fixed income, from the equity markets. This is designed to be stable, a good source of incremental yield in the portfolio, but also give some growth given that it has 50% or so earmarked for stocks. Okay, and now just in terms of portfolio positioning, I think this is the big theme that we're seeing here. And if I could draw your focus to the 2 lines, the orange line is a basket of stocks that exclude those most exposed to artificial intelligence themes. And the purple line, or the burgundy line, is a collection of 100 or so stocks that are most exposed to artificial intelligence. And this is not this easy, right? There's different flavors of each of these stocks. Within the orange line, there's cyclicals, there's financials, there's low volatility. Within the burgundy line, there's software, there's hardware. There's different ways to play the AI theme. But what you can clearly see here is at the start of the year, as I described, we had a re-rating in the tech-oriented area of the marketplace. And then since that tariff announcement, it's been one way upwards in terms of momentum in the market, a very narrow stock market driven by very few names, mostly of prominence. When you hear Mag 7 driving a lot of the CapEx and the spending, trying to compete in this arm race to deliver the next best thing and catapult earnings to a level to reward shareholders. And in contrast, the rest of the market sort of has been left behind. Now, this dynamic has sort of reversed on its head a little bit here in the start of 2026. Now, once again, on the margin, we're tilted away from this because we recognize that the markets are efficient. We want to be able to deliver those types of returns to the underlying community in a cost-effective way. But here so far in 2026, the story has sort of reversed in the sense that the U.S. equity market is flat, but underneath that, there's a tremendous amount of volatility and a lot of software companies. The market is looking through to the long-term growth prospects and really responding negatively because their business model is sort of under fire as we start to see these agentic models and these strategies that are putting a lot of these businesses at risk. So I think our thesis continues to remain that we're just tilted away from areas that we think carry some valuation risk. Okay, and why is that from our perspective? You can see how strong earnings have been over the last few years. Obviously, we have the COVID situation in the 2020 and then the reopening in the 2021 timeframe. But since that time, these companies have been able to clip on an earnings growth story that is pretty phenomenal and is well above trend in terms of historical perspective. And a lot of these companies are big balance sheets, pristine free cash flow, which is now coming under some pressure, tremendous amount of pricing power, almost monopolistic type categories, and they're driving a lot of the boom in terms of capex associated with this AI theme, and have been able to deliver on those results. Now, from our perspective, I think if you flip forward, we're just a little dubious of that, right? And so the market is sort of priced to perfection. I think it is the most appropriate term that you see on this graph here. And the easiest way to interpret this is if you look at each geographic market, and we have the US, we have Europe, we have emerging markets, we have China, we don't have Japan on here as well. It's sort of a whisker diagram to show you the extremes in terms of valuations. Where we're at today versus the median and the interquartile range over a 20-year time horizon. This goes back a little bit longer, obviously, for multiple markets. But in terms of being a capital allocator today, it's not easy, right? So from our perspective, we're a tad cautious. We're on the organization's long-term stock bond mix, right? Which means 70% or so in stocks. But we want to do so in a very judicious manner because we want to tilt the portfolio to things that we think give us a tad of a margin of safety given where things are valued. So if that earnings story doesn't materialize and all the capex that is flooding into these technologies, which we think are going to be transformative, we are using some of them in our own personal life. I just showed Chris some things that I was working on this morning. The tricky part, though, is that going to be translated into the earnings growth that the market is anticipating? And when you combine that with the healthy level of valuations, we're a little bit skeptical, and which is why we're a little bit more conservatively positioned. But capturing a good chunk of it in passively oriented indices.
Fantastic. Thank you, Nick, for that. I think it's a great segue into sort of the bigger themes driving markets today. You've highlighted the great divide in the US, AI and non-AI, the valuation concern you have, the strength of international markets. All of these are part of the themes that are driving markets today and have generated those fantastic, I think, returns, double-digit returns the last couple of years. The question every time as we start the year is, will it continue? What's next? What are the risks out there? And what are the themes that we have to be thinking about? And so we have a great collection of investment professionals on the line, in addition to Nick and Chris at Hurl Callahan. We've highlighted here on the agenda members of different firms that serve as medallion partners for the foundation. And we have some representatives here today that can help give their perspective on what they see out there in the marketplace. So what we thought is we go around the room, if you will, the virtual room, with some questions, big picture questions, and then we'll go into sort of the themes and how you think about them when building a portfolio. And I might first start with Diane at Truist, who is a great partner of the foundation as well. And high level, Nick went through all the big sort of themes out there, but there's also the influence of both fiscal policies, so what tax and spending might do in the United States, and monetary policy, what the Fed might do. And it's been interesting times this year and last, but this year going forward with Fed leadership, independence, all of that. So what I might do is turn it over to you, Diane, just to get your thoughts on how Truist thinks about the impact of the fiscal and the monetary dynamics on today's markets and what you see.
I sure will. Thank you, Mark, and good afternoon, everyone. And great to follow my friend Nick Fazzi, who really did a great job setting the stage, broadly speaking, for the financial markets. So, Mark, as you asked, I'll sort of start with the big picture, and then we can continue to funnel down. From a fiscal perspective, it's important to remember that this is a midterm election year. And regardless of who is sitting in the White House, that administration wants to keep voters happy. And sure enough, we are expecting to see a tremendous amount of tax refunds coming into consumers, in April. Over 500 billion as the total number. But what's really important is it's almost $150 billion more than the previous year's tax refunds. That number is akin to what our second COVID stimulus check was back in December of 2020. And we know as Americans, when we get money, we like to spend money. So that's from the fiscal perspective. It's going to be a lot of stimulus providing impetus for consumer spending. And then, Mark, as you pointed out, from the monetary policy side, Jay Powell will finish his term as the Fed chair in May, and the person who has been selected to follow in his footsteps. Now, he does have to be nominated by Congress, but that's Kevin Warsh. And he himself has served as a Fed governor in the past, and importantly, during the financial crisis. So I think he'll be a great leader. And we have to remember that the Fed has already cut rates by almost 2 full percentage points since the fall of 2024. So we have an overnight Fed funds rate of 3.5%, down from 5.25% a year and a half ago. That we know works with a lag. So that also provides some tailwinds for the economy. The Fed has a dual mandate of price stability, so keeping inflation at bay, and full employment, making sure the unemployment rate doesn't skyrocket. Right now, both of those are not in a bad state. CPI, the inflation rate is hovering around 2.5%. So it's not exactly where the Fed would like. Their measure, their goal is 2%. And so we've plateaued on the price stability progress. And the payrolls, the full employment we're still at pretty full employment, but we've certainly seen a cooling of the labor market. And so when you've got both of those mandates kind of tugging against each other, that points to a Fed that, at least for the next couple meetings, might not cut rates further. We might see, Kevin Warsh come in and cut rates 1 or 2 more times, but the Fed is probably pretty close to being done, with or without 1 or 2 rate cuts. So I don't mean to sound so Goldilocks, but that sort of sets the stage for us.
Yeah, thank you. And I know there's a lot of talk around independence of the Fed, and we don't have to get into it now, but the expectation and the hope is lower rates or lower interest rates sort of spur the economy and provide stimulus that way too. But you can overheat an economy if you're not careful, both fiscally and monetarily. One way maybe to slow things down is to put a lot of tariffs out there and charge a lot of companies tariffs. So I might just turn to that topic. Nick, you mentioned April Liberation Day was a volatility a day of volatility, a month of volatility. But since then, markets have come back pretty strongly. How do I might turn to Morgan Freeze, Phoenixville Federal, and Addison Capital specifically, just to get your thoughts, Morgan, on the impact of tariffs today and how you think about them in terms of earnings and earnings growth and investment themes in general.
Sure. And appreciate the opportunity to speak today. It's nice to be here. As you sort of alluded to, we've been in a bit of a holding pattern since really last February, right? And we've certainly, as a market and market participants, had a lot of headline fatigue since that point. We've obviously seen a lot of turbulence, and this is certainly one of the areas of the Trump administration's policies that has a bit of an asterisk to it, because we're all kind of in this wait and see type period. Now, this said, right, the global market is no longer really anticipating these trade shifts. They're actually recalibrating towards that new sort of tariff-first economic architecture, assuming that the Supreme Court does not rule it unconstitutional. And that news is probably slated to come later this week at the latest. So that will be interesting to see what comes there. Really, four core things that we're thinking through as it relates to positioning and the portfolios. The first is that around the revenue dynamic to all of this, right? Moving from income to imports. Second is then the sort of dichotomy that we're seeing in the equity markets, right around domestically, where we're seeing some winners versus some multinational sort of squeeze dynamics. Third is how fixed income markets are reacting to the Supreme Court sort of hedge and perspective that's to come later this week. And then fourth is really that is as the sort of AI kind of deflationary counterweight to all of this. So on the first point, right, as we think about the Trump administration's successful pivot towards using tariffs, right, this is certainly a primary federal revenue source. I ran some interesting numbers here. The weighted average tariff is about 13.5%. So that represents one of the higher rates since 1946. So that shift is projected to generate roughly $2 trillion over the next decade. And certainly and functionally should act as the primary funding mechanism for a lot of the permanent tax cuts within that one big beautiful bill. On the equity market front, right, there's a bit of a sharp divide here. Right on the first point, we are really thinking about this sort of reshoring tailwind, right, bringing a lot of the manufacturing back to the U.S. And we think that that's really what's driving a lot of the outperformance, specifically in U.S. focused small and mid cap companies, really the Russell 2000, that are continuing to outperform, right, as they avoid a lot of the import costs and certainly benefit from a lot of the deregulation efforts, specifically domestic energy within the U.S. That sort of comparison then, and compare and contrast to that multinational compression, large cap firms with those more so global footprints are certainly facing a bit of stagflation type pressure, right? You think about major manufacturers, Ford and John Deere, they have reported quarterly tariff costs in the hundreds of millions of dollars. So at some point, they're going to need to start to sacrifice either margins or pass those costs on to the American household, which is probably not a palatable situation. I think that the fixed income market is certainly taking a more cautious kind of wait and see approach to all of this. As an example here, I think that we're certainly subject to some headline risk regarding the Supreme Court's ruling later this week, I think by Friday. I think that Diane, sort of hinted at this, right? A potential ruling by the administration could trigger about $130 billion in refunds to importers. So that could create a lot of private sector liquidity injections and could simultaneously widen the federal deficit. So that certainly is playing into some of the 10-year moves that we're watching being a bit sticky and volatile. I think an interesting dynamic to all of this is obviously tariffs are a bit nebulous. AI is even more nebulous. But economists are increasingly viewing AI and really the general purpose technology that it is as an essential counterforce to some of the tariff-driven inflation. Companies that have successfully integrated agentic AI, they are achieving productivity gains that are certainly offsetting the rising costs of some of the imported raw materials. And certainly that's allowing S&P constituencies to continue to maintain historically high margins despite some of the trade friction. So I think that Mark, that's hopefully a helpful starting point on that. I could spend hours in the AI trade, but I know that we want to move the agenda along. So
I thank you very much. It is an interesting dynamic, the inflationary pressures, events versus the AI deflationary pressures, perhaps. We have about 10 minutes left or so of our time together, and as we sort of talk through the last theme very briefly on AI, encourage anyone on the line to ask any questions that they'd like, either by raising your hand or sending it through the chat, whatever you'd like to do. We'll try to get those questions answered. While you're thinking of those questions, we just heard a lot about the great divide in the stock market, AI versus non-AI, and the influence might be more productivity, which is great. Turn it over to Vince at S&T just to get your thoughts on the theme itself, not to explain AI to us. I may not understand it, but generally thinking, how do you see the theme playing out in your portfolios?
Thanks, Mark. I think the panel and Nick certainly have done a great job already covering a lot of this topic. But speaking to tech, when it gets to 35% of the S&P, that's a weighting we don't often see. That's a consideration. When you think about the arms race that is going on, both by sovereign nations and by corporations, and the amount of expenditures that are being made on AI, that can be a concern as well. Is it going to pay off in the end? Then as a disruptor, it's obviously, a major disruptor. Productivity gains are terrific. The need for people is a competing element. So with gains of productivity, are we eliminating people? Any college kid at this point in time trying to find a job is running into some of that headwind. So as a disruptor, it's obvious that that's going to affect people's lives. In terms of semiconductors, along a rule of law was Moore's law, which every 2 years the capacity would double. Well, I think you're going to see an acceleration and a growth in the ability of AI that's going to blow Moore's law out of the water. So that's going to be a consideration as well. I think, are we going to have a reversion back to the mean? I was talking to an attorney that was looking to implement kind of an AI program in their firm, and about a year and a half ago, that cost was about $500,000. That cost now is about $50,000. So, the price compression on some of these technologies is going to be a consideration as to the value as an investment. Power consumption is another consideration. There's massive build out in power consumption. What happens if this process gets more efficient and the need for that build out it comes into question? So, those are kind of the things that we think about when how to quantify AI. I mean, over the last 2 months, you've seen it just blow through different sectors. Asset managers, law firms, commercial real estate firms have seen their stock prices decline because of the potential for AI to disrupt their businesses. We're seeing that. We'll probably see that on a rolling basis for certainly the next couple of years until we figure out what it all means.
Yeah, it seemed like last week there was a news item that targeted a different industry sector every day. It was the law firms on Tuesday and it was the wealth managers on Wednesday. So we're all targets, I think, of the new technology one way or the other. But there's, as you mentioned before, Vince, there's opportunities in all of this, and then there's risks, and how you balance those things is really the job that all of us think about every day. We do have a question in from Ray on the topic of commodities and cryptocurrency and whether those areas do play a role in the portfolio. And I'm going to go to my crypto expert, Chris Valerio at Hurdle Callahan first to just sort of big picture, how do these two alternative categories sort of fit in, do you think, at Hurdle Callahan?
All right, Mark, put me on the spot. First of all, we do not own any Bitcoin or any form of it in the public equity portfolio. There have been in the past venture investments made in startups that were either back then it was probably blockchain, and there were some coins that were created back then that some of our venture partners did have some investments in. But I think the struggle that we have around it is we would rather implement it through a venture portfolio where you have binary outcomes, right? If we're going to allocate money to venture, we know we're going to have, let's say, 5 to 6 managers in that are going to make, call it 20 to 25 underlying investments, knowing that some will not amount to anything and some might be a total success. So hopefully that encapsulates it. Nick, I don't know if there's anything that you want to add on top of that.
Yeah, I was just going to say sometimes it's hard to put a value on something where there's no tangible cash flow. And it's sort of like our industry's stock answer to say, hey, explain why we don't own something, right? You have to make sort of an observation on where you think the price of something is going to go. And I mean, raise your hand if you thought silver was going to do what it did and the mechanics behind that. So it's hard for us to do that, and it becomes more speculative than making an investment decision. One of our active managers has a very big position in Newmont Mining, which is a gold-oriented company that benefited, obviously, as we saw the price of gold ratchet up forward due to monetary fiscal concerns. But they're able to know that company, understand its cash flows, understand that if the price of gold does X, what it means to their profit margin, what their capacity is, so forth and so on. So we're more likely to get exposure in that manner.
Right. So I think that's helpful. Commodities and crypto through an indirect way of playing the markets and investing into strategies or funds that invest in it directly. Another question from Tony is what would the impact be if there is lower consumer spending going forward and higher debt accumulation, perhaps and assumingly at the national level going forward? So lower spending, more debt. How does that translate into economic growth? I'll throw it out there to anyone there who wants to answer that, Nick or Diane or group.
Can we split it? I'll take the consumer spending, and someone else can take the hard part. As I mentioned, there's a lot of stimulus coming through in the form of tax refunds. So that's going to be really important for this year. Consumers do spend money when they get it. The other important consideration for consumer spending is real wages are positive, and that's not always been the case. And so when I mentioned the CPI, the inflation rate at 2.4 or 2.5%, our average hourly earnings rate is a full percentage point higher at 3.7%, even a little more than a full percentage point higher. So I'm not sure we'll see a slowdown in consumer spending. And I will let one of my esteemed colleagues talk about the good old kick the can down the road on fiscal debt.
Yeah. And maybe I think that has been a perennial, risk concern in terms of debt, and it doesn't look like it's being addressed today or in the near future. So that potentially, in my view, and we can talk a little bit about this, but it's inflationary or weakens the dollar. It adds additional risk to the growth story in the U.S., so it offsets a little bit of that. So I think it's a big macro impact that still to be determined in many ways on what that debt buildup might look like. The other question we have from David is, do we have a portfolio or macro level hedges in place, or is it really that hedging and strategy done at the underlying fund manager level? And I'm going to turn to Nick on that just to get your thoughts on that question.
Yes. So I would say at a very high level, at the 70% or so where we think there's risk in the markets. And once again, we're not calling for market correction. We're not calling for dislocation, but there is valuation risk, right? I think we're attuned to that, right? And the idea that we're able to, once again, you heard all the panelists talk about all the issues that we're facing. Any idea that we have any certainty on how things are going to play out, I think is unwarranted, right? So we're very humble in our ability to call the direction of markets. That's why we rely on passive exposure. I think at the very high level, for that 70% on the margin, our first step is when we think there's risk in the markets in certain sectors, we're going to tilt it appropriately. So we're doing that, right? Some of the ways we're doing that, we own low volatility stocks within the U.S. equity portfolio. That's one way to tilt it more conservatively. We own international stocks that are carrying a better valuation metric. We do things where we do have some explicit hedges in the portfolio designed to be more asymmetric in their payoff pattern, given where things are valued. And if markets continue on this path, which they can, if you think back to the TMT bubble, there are periods of time where things can get extended for very long horizons, more than investors can tolerate. So that's why we're diversified, right? I think diversification is very important. So at the end of 2024, everyone hated international stocks. right? And you poll all the analysts out there, do they think the US is going to outperform international stocks in 2025? Yes, we do. Recency bias, right? So I think this idea of diversification and leaning into things that maybe are going to be uncorrelated and provide more diversification benefit than what is ruled today is important. And we have some of that at play in your portfolio.
Very good. And we're a couple minutes over our time. Kate did not ask a question, but definitely thanked all of us for the work we're doing. Thank all of you for the work you're doing on behalf of the foundation and the community. With that, I'll turn it over to Bob.
Thanks, Mark. So I just wanted to say thank you to all of our attendees today and our presenters as well. It's great information. If there are any follow-up questions that you didn't get a chance to ask today, please, as I said earlier, follow up with me and we'll get you to the right folks in connection with them. If you haven't gotten your tickets for Sweet Charity yet, Tuesday, March 3rd in Downingtown, we would love to see you there. Reach out to anybody on staff. We can help you with that process. And appreciate your time today and support of us as a foundation and the greater community in general. So thanks for attending. Have a great rest of your day, and we'll see you again soon.